Welcome back to the channel. This episode we will look at all that has happened the last week, which is the first week in March. The meeting between the Fed chair and the House, and also a lot has happened between Russia and Ukraine, the invasion of Ukraine, the energy price, and we will have a look at the market, the S&P 500, Dow Jones and NASDAQ. We will also have a look at the US Treasury yields, 10 years, 5 years and 30 years. We'll see what the interest rate is all about. Don't forget, the main challenge for now is still the inflation. The inflation is high, is the highest in 40 years. We will have a look at all these barometers. The Fed chair was at the House this week, and a lot of questions was asked about the economy, inflation, the effect of Russia and the Ukraine conflict. But what you need to know, the Fed chair said economy was growing, is growing fast, supply chain constraint is easing, a lot of other things that are going in the right direction. However, the inflation is the key, is the problem, and the challenge is that the Fed said he knows the job they have to do. The job is to get inflation down, and they will do all that is possible within the tools to be able to achieve that. The Fed chairpoint signaled that it could, favor 25 basis point hike, and that could be multiple throughout the year 2022. Also, the high energy price because of the Ukraine and Russia conflict, which it could also exacerbate the rate of the inflation and the rate hike this year. But there's a different thing between theory and practical. You could say all that you will do within the monetary policy, but the reality on ground might not favor your policies. So reality on ground, sometimes it's different from the policy, and impact, it will be more impactful than whatever policy you are making. No one actually foresaw that Russia and Ukraine will be at this point, which really the energy price, WTI crude is about 110 or 112, the highest in about 14 years or so. So it really depends on the conflict between the two countries. Also, what you need to know is that the market actually appreciates the fact that the Fed chair said there will be, it favors 25 basis points. That is key. The market likes that. Market doesn't like uncertainty. The market like when they have information, when it's abreast of what is about to happen. Uncertainty is not the friend of the market. We're in risk of environment. The sentiment is bearish. The equity market is bearish. Investors are flocking to Treasury yields. Last week, 10 years was about 1.8%, while 30 years rose to 2.19%. The relationship is inversely related. The yield goes up, the price comes down. The price goes up, the yield comes down. Investors are less tolerant to risk. On the equity market, the S&P 500 is still within correction territory. Dow Jones lost about 600 points, was it on Wednesday? On Thursday, another 400 points. The NASDAQ, the tech index is also down. We're still within the correction territory. In fact, most analysts will tell you that we're already in bear market. So it's a season where you really have to lower your expectation of returns. We're no longer in 2021 or 2020, where you have a huge return on the tech sector. Now you really have to play your, balance your portfolio with defensive stocks, and also if you're exposed to energy, then good for you, but I don't think now is the right time to jump on energy, because the energy is already high, However, you can still play your portfolio in the right way by ensuring that you have equity or stocks that has good valuation. Valuation matters. This is a time to check the nitty-gritty on the balance sheet, income statement, and cash flow. It is very key that you do your valuation for your asset. You do your valuation for every asset in your portfolio. Let's have a look at the S&P 500, Dow Jones, and the NASDAQ. Also, this is a chart for 10 yield, Treasury yield, and that of 30 years Treasury yield. You can see that the 30 years is just about 2.1719%, while that of the 10 years is about 1.8%.
Chart for S&P 500. This is a weekly chart. Let me just draw this support line I can see here. Let me start from here. Okay, right. As a support line there. We're currently on support. That is in support of 4,328 on a weekly chart. However, what you need to see before the last candle, the candle before it was an hammer. So the previous week was a bullish week. It was a bullish reversal. The hammer shows it. Now, the current candle here is an indecision. So this might just point that we might be consolidating within this range. Let's have a look at it on a daily chart. The daily chart will review more. On a daily chart, as you can see, it's an hammer. The color of the hammer does not matter at this point. You can see that it's a red candle, but it's an hammer. It's a bullish reversal signal. However, we are trading below 20-day moving average. We're still within the correction territory. So this might just be that we will consolidate around here for a while because the previous day, the 20-day moving average was acting as resistance here before the last day of trading, which was an hammer. But you can also see the support line I drew on the weekly chart is also here on the daily chart. Sorry about that. My mouse can be very funny sometimes. Okay, you can see it there. So it's acting as a support. The hammer is sitting on the support, which is very significant. A bullish reversal sitting on a support, an hammer sitting on a support. Because it's a bullish reversal. However, it just might not go beyond this 20-day moving average here as resistance. So we might be consolidating around here. But we are, if you notice that from the beginning of the year, we have not gone far this range. Let me just draw this. So, and that is, here is the 50-day moving average. So we have been trading between 20-day, below 20-day and 50-day moving average. So as you can also see, this is like forming an range. Yes, here he broke it down. That was when we went deep into the correction, but he reversed back as a bullish candle. So meaning that we're trading within this range now. So for S&P 500, let's look at Dow Jones. On the Dow Jones, we are trading below 20-day moving average as well on a daily chart, and also the chart looks similar. Let me start by drawing the support line here. You can see that it is also an armor. It's also an armor here. An armor here. The armor is also on a support. And you can also see that we have been in between this range from the beginning of the year, between this range, which means we have been in between 20-day and 50-day moving average. You see? We have been, yeah, he broke it down here, but back in the range. So between this range, let's have a look at it on a weekly chart. On a weekly chart, as you can see, this is down the correction at the upper week. Here is an indecision. So it just tells you that on a weekly chart, we are still within the correction territory, and we might just be consolidating around here. Let's have a look at the NASDAQ. On the NASDAQ, it is okay. Let's look at it. We also have a resistance that has come support on the NASDAQ. So we're sitting on a support on a weekly chart here, and it also we have been trading between here from the beginning of the year, which is below the 50-day moving average on a weekly chart. Let's have a look at daily chart for NASDAQ. On a daily chart, it is very similar to the Dow Jones and the S&P 500. We have a support here. The last candle here is sitting on its support. It is bearish candle. However, the same range that we have been trading from the beginning of the year is here. This is the resistance. But what you can see here is that this is the 20-day moving average. So we are below 20-day moving average on NASDAQ. We're below 20-day moving average. Guys, this is the year that you need to reduce the expectation of return. You know, by the time the interest rate hike is priced in, you know, and we will have multiple by as the Fed suggested, you just my NASDAQ, the tech index is not likely to give return like 2020 and 2021.
We have seen the chart for the S&P 500, Dow Jones, and NASDAQ. We are still in correction territory. We might actually consolidate for some time around this area, but be careful. Do your valuation for for whatever you if you want to buy the dip. Before you buy any dip, make sure to do your valuation. Some of the stocks are already bottom, some are not bottom yet. Buying the dip while stocks are going down may not be the best at this time, because nobody is sure. We might be going into the deep bearish market. No one is sure. However, whatever you do your valuation. Thank you for watching this channel. Thank you for subscribing. We will continue to produce content that will support and educate your investment journey. Please call again. Thank you.